The latest Canadian GDP numbers helped remove any doubt about the impact that tariffs from the Americans are having on this economy. Of course, we saw GDP shrink 1.6% in the second quarter, exports taking the brunt of that. So, with no trade deal in sight with the Americans, what happens next? Joining us now for a closer look at the economy is James Marple, Associate Vice President, Senior Economist with TD. Great to have you back on the program.
It's great to be here.
Interesting times indeed. I know you're busy in times like this. Let's start with an overview of Canada's economy. What stands out for you?
Well, obviously, as mentioned, we've been hit by this major tariff shock, and we have to sometimes, remind ourselves that we're a small, open economy with a large share of our production going to the United States. So a quarter of everything we produce is exported, and three-quarters of that go to the United States. So a whole fifth of our economy goes to the U.S. So I think what's not surprising is that when we've had this tariff uncertainty, we had a major hit to our export sector. I think what's good to see is that outside of that, we have seen spending hold up, but really the decline has been focused on places you'd expect to see it. Autos were hit really badly. Some of that came out in an increase in inventories, which maybe just reflect the fact that there is some uncertainty about what tariffs will remain in place. We've produced some things. They didn't get to go to the U.S. because the tariffs were there, hoping that maybe some of them come off. And we have actually seen some reduction in some of those rates, I think, in the months since. That could bode well for future exports. But, more broadly, we've had that we're starting to see interest rates feed through to the economy. We've seen, the housing market show a little bit more resilience, sales certainly improving relative to where they were. And consumer spending, which has been weak, certainly was weak in the first quarter, rebounded quite well in the second.
Let's get into that, of course, because for certain parts of the economy, as you talked about, exports, steel, autos, it's been a pretty tough go, but it's not feeling its weight across the entire economy. We continue to spend. Is that one of the bright spots there, that we other parts of the economy say, oh, I still got money in my pocket?
Yeah. Well, I don't want to understate it. I mean, 1.6 decline in overall GDP is, you can't, it's nothing to shake a stick at. We can't ignore it. But if you kind of look through over the first half of the year, we did a bit better in the 2% growth in the first quarter of the year. And then the domestic demand component, which you mentioned, household and business spending. Well, business spending has not been very good, especially on machinery and equipment. That reflects the trade uncertainty. But consumers, 4.5% annualized growth in the second quarter of the year. I think that's really positive, and I think obviously indicates the fact that we have had continued pretty good resilience in the labor market, and also the past effective interest rates that I think are starting to show through in that, and as mentioned, in the housing market.
Now, I know I've had other guests from TD Economics, Derek Burlton among them, sitting in that chair in recent weeks and months saying there's an expectation of a mild recession. These numbers don't look great for the second quarter. What are we still thinking about that, and what would actually lift us out of this?
Yeah. Well, we typically think of a recession, I mean, it's maybe too simple of a rule of thumb, but as 2 quarters of economic contraction. We certainly had it in the second quarter of the year. The third quarter, we may actually escape without a contraction in GDP. I mean, we'll be continuing to monitor the data, but certainly having some of that those exports fall off so quickly and that drag come through, we may see a bit of a rebound, especially with some of the news we've seen, as mentioned, since on the trade front. We have had the large carve-out for USMCA compliant goods. We have had that we see the domestic spending holding up, and inflation is performing a little bit better, at least in the near-term data. So all that suggests that we could see a bit of a rebound as we head into the second half of the year. Now, we're not expecting rapid growth, and probably will be pretty weak. But in terms of recession, I think the other thing that really what resonates mostly when we talk about recession is what happens for the unemployment rate. The unemployment rate had been rising through most of last year and even the year before, and we've seen actually more of a stabilization in that rate. So, the kind of spiking or increase in the unemployment rate that would typically indicate a recession is certainly not evident in the data to date, and I think, as mentioned, there's reason to think that it won't be, especially with changes in population and labor force growth. That said, there are real pockets of weakness in those trade-exposed sectors and regions of the country. Southwestern Ontario and Ontario and Quebec more broadly. But outside of that, no signs of a broad based weakness in economic activity.
Of course, everything that you and I have been talking about to this point is of great interest to the Bank of Canada, of great interest to Canadians who are wondering what the Bank of Canada will do next. I know they're going to have more data to build on, another jobs report, another inflation report before we get to the 17th and that rate decision. What do they do with all this information?
Well, I think September is going to be a very close call. I mean, on the one hand, we've seen the economic weakness come through in Q2. The Bank of Canada had expected that in their last MPR. They noted that there would be a decline, came in pretty close to their estimate. So I think they are going to be looking at the inflation numbers as well as the labor market and the continued drag on activity that we will see from trade. So they're obviously always balancing inflation versus economic activity and economic weakness. Inflation is not quite where they would like it to be. I mean, their core measures are close to the 3% mark on a year-on-year basis. Certainly signs of improvement, and the shelter component has been coming down. There is, obviously signs of the trade-related weakness, but not a ton that it's gone through to the rest of the economy. And they have cut rates already quite a bit. I mean, they're down to 2.75%.
Do we feel that's a neutral rate? Is it still restrictive?
I mean, I think it's definitely in the range. We don't know with certainty what the neutral rate is, but it's certainly within the Bank of Canada's own range and pretty close to where we would see a neutral rate. So they really want to see that the economy is weakened enough to support lower interest rates. They don't want to see more bubbles in any areas of the economy or see more price growth. All that to say, I think September they may have a case for holding, as they have in recent meetings, but there is still a case for more rate cuts later on. I mean, it could be a situation of continuing to monitor the data, just as they have been doing, looking at those pluses and negatives. I think a little bit of support makes sense through the end of this year, just given the ongoing trade weights on growth and the fact that we have seen the inflationary impact has come through some of the trade measures, but some of those now with the de-escalation between Canada and the US and taking off some of those tariffs, that is less of a threat than it was.